Let's cut across quickly now to RBI Governor Raghuram Rajan, who started speaking.
For new bank licenses. Immediately after, and using the learning from the licensing exercise, as well as building on its previously released discussion paper on banking structure, the Reserve Bank will work to give more licenses more regularly, that is, virtually on tap. It will also set out categories of differentiated bank licenses that will allow a wider pool of entrants into banking. Turning to markets, to expand investor demand for inflation-indexed bonds, design changes improving their attractiveness to the general public are being worked out. In order to expand the market for corporate bonds, banks will be allowed to offer partial credit enhancements to them. The feasibility of limited re-repo or rehypothecation of repoed government securities is being explored. As regards foreign investors, the Reserve Bank welcomes them and will continue to work to ease entry costs while reducing risks for investors and the volatility of flows. Towards this end, modalities allowing foreign portfolio investors to hedge their currency risks through exchange-traded currency futures are being worked out in consultation with SEBI. FPIs will also be allowed to hedge their coupon receipts falling due during the next 12 months. KYC norms are being simplified for foreign portfolio investors. To encourage longer-term flows and reduce volatility, FPI investments in G-SECs will henceforth be permitted only in dated securities of maturity 1 year and above, and existing investments in T-bills will be allowed to taper off on maturity/sale. Any investment limits vacated at the shorter end will, however, be available at longer maturities, so overall FPI limits will not be diminished. Turning to the inclusion and customer protection agenda, we intend to enlarge the banking correspondent base through the inclusion of new entities as well as considering a relaxation of existing distance restrictions. A number of measures to protect consumers are being envisaged. For example, banks should not levy penal charges for non-maintenance of minimum balances in ordinary savings banks accounts and on inoperative accounts, but instead they should curtail the services accorded to those accounts until the balance is restored. Finally, and last but not least, to tackle distress in the system, the comprehensive framework we outlined to help banks reduce their NPAs, even while putting distressed projects back on track, will be effective from today. We will monitor progress and make any needed adjustments to ensure it operates smoothly. I hope that the only thing that was surprising about monetary policy today was a lack of surprise. I'm glad financial markets and analysts have started understanding what we are doing. Thank you very much for your attention.